Good afternoon. This is Arlan Suderman, Chief Commodities Economist with INTL FCStone. Glad to be back with you for another look at another USDA crop report. This June 30th report kind of has a reputation of being maybe the second most influential in markets as far as surprises and impact on prices. It becomes the filter through which the trade will view the weather forecast going forward and the fundamental supply and demand information going forward through the rest of the summer. And I think we saw that played out pretty well in the reaction to today's report. Now, as we look at the numbers that came out of this report, they did have some surprises in it. The number one report, by the way, I said number two for June 3rd. The number one would have to be that January report. That is full of a plethora of data, numerous different reports within that. And so it's common to have surprises. June 30th report, not that much data, but frequently has surprises within the numbers that are there. And as I said, we certainly did see that this morning. As we go forward, and it's important to keep in mind that price is still a function of supply and demand. I'm going to keep this slide and keep showing it from time to time, but is modified by the flow of money. So before we go on the numbers, I want to look at what is the money flow doing. And we see here the weekly CRB index, the Thomson Reuters CRB index, reflecting positive money flow. We see particularly in the lower right-hand corner there, we've done more than a 20% correction of the downside move, moving into a bull market with many of the commodity indices. The commodities have been in vogue. In fact, if you look at in fact, I'll show you here in a little bit what the commodities specifically have done. So maybe I'll save that comment for a little bit, but let's look now at the connection between the CRB index and money flow into corn, soybeans, Chicago, and Kansas City wheat. We see that it has been rising correspondingly, just as we have, just as we have also on the major indices. We're also seeing that we're pulling money into the grain and oil seeds. So there is a correlation. In fact, you see up the top right-hand corner that we see a correlation of 0.72. A correlation of 1-to-1 means when A rises by X amount, B rises by X amount. And generally we figure a correlation of 7 or higher is a fairly good correlation. And so we see that good correlation when the money's flowing into the broader commodities, it tends to go into corn, soybeans, and wheat as well. Now, let's see specifically what has been hot. That would be the soy meal market, basically a 50% rise, trying to look at that number, 49% rise over the last 3 months. Soybeans right behind that at 27%. So soybeans and soy meal have been the hot commodities that the fund's been going after. It actually started due to strength in the vegetable oil market as the global vegetable oil supplies began to tighten. But then it switched over to demand for protein. We saw that with the problems in Argentina. Argentine quality and yield hurt because of persistent rains at harvest time, and that pulled down the supply. Some customers started switching to U.S. supplies. Our crush margins are good, increasing demand for both soy meal and on soy beans. As we look now at the corn, we see that we've seen modest losses in corn prices over the last quarter, and wheat more significant losses. So soybeans definitely the leader here as we're talking about the grain and oilseed complex as a whole. Now, as we look at the numbers from this morning from USDA, we see that. Okay, there we go. We see that USDA came in with 981 million bushels of wheat in stocks as of June 1st. That was pretty much expected. That was the end of the marketing year, 2015-16 marketing year, pretty much as the trade expected. Corn, 4.722 billion bushels, almost 200 million bushels above trade expectations. And so what this says is that we're probably not feeding as much corn as what USDA would suggest. Keep in mind that USDA's feed estimate for corn for the 2016-17 year is very aggressive at over 5.5 billion bushels. We'll likely see that pared back on July 12th. So from a stock supply side of things, we know that we have more bushels available. And then when we get to the acreage side, we'll see that we have more acres available as well. So we've made the safety net a little bit bigger against an adverse weather scenario this summer. On soybean stocks at 870 million bushels, the average trade estimate of 41 million bushels below that. My trade estimate, 860 million bushels. Yes, I'm kind of kicking myself because my original estimate, 870 million. I thought that's too high. USDA won't go that high. Should have stuck with my estimates, with my analysis. So that suggests that we have a little bigger safety net. But when you look at the current export pace, I'm not worried about those bushels disappearing. I don't think that they're going to be an issue for us when we get to the end of the marketing year and to harvest of this year. Okay, a little bit there, getting the right bushels. Okay, as we look then at the acreage number, we see here corn acres at 94.148 million acres. That was above the high end of the trade guess, although Landworth did come up with another estimate yesterday that was basically very similar there, above 94 million acres. A lot of those acres coming from Minnesota, but also several other states. If you look at the state-by-state breakdown, it came from those states that had rapid planting progress early on. So as we look at then the soybeans, 83.688 million acres, increase in acres coming from double crop, particularly 300,000 more from Kansas alone. Planters following the combines as they harvest the wheat, they're planting soybeans. Double cropping going to be big. When you look at other states that saw increases, again, it was those states that had rapid planting progress early on, but also the states in the eastern Midwest where corn planting was delayed. We saw some switches over to soybeans that may have gone into corn otherwise. All wheat, 50.816. I think the real surprise here is we increased winter wheat acres. Increasing winter wheat acres in the June report really wasn't expected. Not a surprise to see the increase in spring wheat and in durum. So bottom line, what does this mean going forward? Well, as I plug in to the acres that USDA provided, in all three of these scenarios, I provide here what I anticipate happening assuming normal weather. And I put a 166 yield in, looking at where the acres are, the increase in acres that we saw in the south this year, as well as in the plain states where yields tend to be hampered a little bit more. I used a 166 yield down 1 bushel from my 30-year average. I know USDA is above 168. They keep changing how they figure their trend yield. I just stick with the 30-year trend. Then I changed my yields, and I also changed my demand estimates, because obviously if you have higher yields, lower prices, you're going to stimulate some demand. If you have lower prices, you're going to ration demand. So I do make some adjustments on demand as well. And you see my anticipated scenario with today's numbers pushes our stocks over 2.1 billion bushels, suggesting a marketing year average cash price of $3.60. Now, if the rains come next week and the rains keep coming and we keep feeding this crop, and I don't anticipate this is a minority odds, I'll put it at maybe 25 to 30% odds right now, but we do get the rains and we get a 172 yield, all of a sudden we're near a 2.8 billion bushel ending stocks. Marketing year average price at 305. So there is considerable downside risk to this market. On the other hand, if the heat does intensify and the rain back off, then we need to look at these ending stocks dropping to 1.2 billion. That's a little bit more generous on the stocks than what it was before today's report, because we had to pull back those feed usage numbers a little bit more going forward in this report. Now, as we look at soybeans, and we see that it's a little different scenario. Okay, let me get back to our soybean table. There we go. With soybeans, I'm going to increase in my anticipated scenario my acreage to 84 million. I'm making the assumption that when USDA surveyed on June 1st, they did not catch all of the double crop acres, and that even this price rally, even as late as it is, if we get the rains expected over the next few days, will result in a few more acres going in. So I'm going to push my acreage up to 84 million. But with the weather patterns and the sea surface temperature anomalies in the Pacific unfolding the way they are, I'm still anticipating that hot August, and we'll talk about that a little bit more as we go here. I'm pulling my yield back to 45.5. In fact, I say pulling it back. That's where I've been all growing season at 45.5 based on that weather story unfolding. There is downside risk to that if the heat is intense and the moisture falls short. But 45.5 I feel pretty comfortable with at this early date. That draws ending stocks at 216 million bushels, or roughly 5% stocks to use ratio. That typically or historically has been considered levels that we need to maintain the pipeline supply at to keep it functioning well. On the other hand, if we get more acres and we add another million total to 84.7, probably not going to increase that much, but I can't rule it out, and we get the rains and we get a 47 bushel yield, we could increase stocks to 573, drop the marketing year average cash price to 910. If, however, we get what USDA says, 83.7 million bushels, and we use demand estimates anticipated by USDA, and we get a 44.4 bushel yield, which would be a 5% reduction, just a 5% reduction from USDA's yield, we drop stocks to about a 3.6% of annual usage, or 139 million bushels, suggesting a marketing year average cash price of $12.45. So the potential here is significant considering the amount of soybeans that have already been priced. I'd have no problem. If you saw Bevan's analysis that came out from our company on market intelligence earlier today, saying that if we get that type of scenario with the heat and dryness, we could see $15 futures. I have no problem with that. I think that's very true. But the marketing your average price probably $12.45. When I give these scenarios, I give what I anticipate, and then I kind of give boundaries. So the center and the right columns of both corn and soybeans are kind of the likely boundaries on the potential range of prices that we'd see. And once again, now that we have acres more narrowed down, yield is the big factor, and of course, what's the determiner of yield? That means weather. So the primary focus from this point forward is weather. Now, as we look at where are we today, this shows topsoil moisture levels. This chart that Lacey made for us, state by state, and the change of percent in the short to very short category, and then the change from the previous week. And then when we look at subsoil moisture levels, we see here too some of the dry areas, particularly Missouri. Now Michigan is pretty dry. Unfortunately, Michigan doesn't look like it's going to get a lot of relief anytime soon, but the southern half of the Midwest certainly looking like we could see good rains through this weekend. In fact, some heavy rains in some locations, and this has been some of the driest parts of the Midwest in here. And this is just in time for pollination, to aid pollinating. I'm not naive. I know there's some corn. I've seen some of the pictures. That's already had some irreversible damage in that area. But it will give a big boost to the rest of the corn, and big boost to corn that hasn't been hurt irreversibly yet, certainly stopping the damage and helping maintain the crop ratings for the southern half of the Midwest going forward. So very encouraging forecast for this weekend. If it verifies, forecasters gaining confidence in it. Now, when we look at the real drivers of this forecast, keep in mind we've talked about the cool pool between Alaska and Hawaii. It has been moderating, and temperatures off the west coast that have been above normal are cooling, as we see in the lower left-hand corner of this graphic. And so we can see here that matches up well with what we saw happen in June of 2005, When we look at 2005 as an analog, it becomes a more significant analog for us going into July and August. And in that year, we saw a broad high pressure ridge stretching across much of the country, timely moisture, but above normal temperatures, pushing the crops. So we'll see how this plays out for us this year. We look at some of the analog years precipitation. And I want to note that in August of that year, we saw Katrina come up the Gulf of the Mississippi, dump a lot of moisture on the southeast and particularly eastern Midwest, kind of giving more of a moisture bias. Otherwise, we were on the dry side for that year. Now, as we look at what Commodity Weather Group's forecast is for the 16 to 30-day period, we see overall a bias toward warm temperatures, but not any sustained intense heat. There's expectations that there will be some intense heat periodically, but not sustained intense heat. Probably greatest at risk in the last half of July is going to be that area around the Great Lakes, particularly the northeastern third of the belt. As we go into August, probably the northwestern half with heat and dryness of the Midwest. And then in September, no real cool, although notice the cool air starting to cool in Canada. At this point, though, with the maturity levels of the crops, I think it'd be premature to suggest any increased frost risk at this point. Now, as we look at what are the take-home points from this, first of all, I'd say the focus now shifts nearly entirely to weather. Outside money flow will impact that. If we have positive outside money flow into the commodities, and particularly any asset class that has a story, and soybeans had the best potential to have a story, then we could see that amplified, see more money coming in than what we would otherwise anticipate seeing, and that will modify the reaction. If, on the other hand, the Brexit results in a collapse of the world markets, money flow running to the sideline, we can still rally soybeans, for example, or maybe even corn if they do develop a story, but it makes it that much more difficult. We're going against the current, so to speak, and so we have to have that much stronger fundamentals. At this point, it's generally positive. In the end, yield will matter more than acres, and that means weather. The safety net just got smaller for soybeans and got bigger for corn. Cash wheat is the anchor around that corn complex. We have a lot of wheat, and look for July 12 USDA to significantly increase its wheat production estimate, meaning more wheat needs to make it into the feed stream, displacing corn. So at this point, I will open it up for questions, and you can enter your questions there on your monitor, on your screen, and I'll go through the questions and try to address them. First of all, I have a question from Zach. And he said, where did Minnesota come up with all these acres? For a state that doesn't have much production in the northern half, they seem to have added a lot of acres since March and from last year. Will the Minnesota acre number come back down after the FSA registration? And I would say no, probably not, because I would argue that last year USDA had probably understated Minnesota acres. Now, a 700,000 acre increase for corn and soybeans was a significant increase, probably pressing that a little bit. But when you look at the margin error, you look at the past history of USDA and what they've done with Minnesota, I don't think they're that far off. I think the acres are probably there and very similar to what they reported. Another question here. If I can pull it up, and thank you, very decent presentation, appreciate it. Soybean futures jumped most today, post USDA report. Some technicians say the top of the year is already in. What's your opinion? Will we see a strong seasonality in July this year? And it's all going to come down to weather. As I said, I think that if we turn hot and dry, and what Commodity Weather Group's been saying, as you saw in the presentation, that end of July and August is a real threat. That's the biggest threat to soybeans. That's when we can have the biggest impact on yield based on that's the pod set time and the pod fill time, impacting the size of those beans within the pod. And I think that if we have hot weather, then depending on the moisture supplies, we can pull that yield down into the 44 bushel range or even lower And if that happens, we have the potential to have beans in the teens on the board. And so that's a big question. If the rains come and the weather's not as hot and we reach a 46, 47 bushel yield, then this market will probably collapse down pretty quickly. Another question coming in from Melinda. Do you feel like the corn market still has some weather premium built in after today's market action? I'd say yes, I do. Based on the fact that the crop ratings are tied for the 6th highest of the last 30 years, if those ratings hold, if the rains come, then that would suggest that we have a yield somewhere in the 166 to 170 bushel range, and we're pushing stocks higher and price needs to go lower, particularly with all the wheat that we have. But that's the big question, is what's the weather going to do? More likely scenario is we'll see that yield in the low to mid 160s, and we will tighten up supplies, but not be a real threat or a concern, particularly with all the wheat that needs to be fed. If we have a strong La Nina, how should this impact Latin American crops next year? And excellent question. If we go into a La Nina, as anticipated, and the latest data showed us just 1/10 of a degree Celsius off of that weak La Nina status, that tends to give us dryness in Argentina and southern Brazil. The intensity of that dryness correlates well with the intensity of the La Nina event. So the more intense it is, the more intense the dryness. Now, it tends to give us good yields in central and northern Brazil to partially offset that. So we'll have to be watching that carefully. But overall, we do expect that risk, and it's another reason why the funds like the soybean complex. Joe asks, what would be a price range you would expect Kansas City wheat to hover around for the next marketing year? Joe, I think I would suggest here that we need to be watching the marketing loan rate and what the cash prices do. And we're starting to go into the marketing loan rate already in the plains and the hard red winter wheat belt. That tends to put somewhat of a floor in the price. Now, the board is well above the cash, so it does leave some downside risk there from a pricing standpoint. But overall, corn is going to be what tries to pull wheat higher if corn gets help from soybeans or the weather. But that cash wheat market's got a big anchor around it. Will historical price relationship between corn and soybeans of around 2.5, the ratio 2.5 to 1, can we continue to have a relationship above 3.0? We pushed it today, I believe it was around 3.2 to 1. That's not that rare to see that type of price relationship, but it usually doesn't stay there very long. I think this is going to be one of those rare years when it makes it a very difficult problem for corn, because wheat is going to be a huge anchor for corn. So we'll probably have a larger relationship, weaker relationship, I should say, relative to soybean prices. Francisco, I forgot to add your name to the question that you had. Okay. Becky, FSA acres are typically smaller in USDAs. Could we see that happening this year once FSA data is released? Yes, because not everybody certifies acres, and we have seen some decline in that. I think the relationship was a little bit, FSA was a little bit lower relative to the USDA NAS than what we would anticipate. Last year, I would anticipate that will narrow up just a little bit, but I think over the last couple of years, we've seen a few more farmers dropping out of certifying their acres. Paul, how much white corn maize will be planted? Estimates, I apologize, I don't have the white corn numbers with me here, and forgot to take a look at that today, so I'm afraid I can't provide you an answer for that. I know that we have the white corn demand in the South Africa, and also Mexico generally takes a lot of white corn, but I do not have the acreage numbers here with me. Switch to, Francisco asked again, since farmers can switch from corn to soybeans each year, should we look at corn and soybeans combined to see how tight the grain markets are? How does the picture look in terms of stocks consumptions this way? You're really talking about a carbohydrate grain in corn and soybeans a protein, and so to some extent they're different markets. And while they share this, they battle for the same acres. I think we need to keep in mind that we're going to be shifting a lot of acres from soybeans to corn, probably at least a 20% increase in corn area in Argentina this year. We'll probably see some more interest in corn versus soybeans in Brazil as well. And of course, the credit problems there are going to make it tough to expand those soybean acres like they have in the past in Brazil. And the combination, I think, keeps the soybean balance sheet tight as long as we maintain that strong demand going into China. Brock asks, what do you think this does for the 16-17 corn and soybean acres looking at next year in regards to this huge surplus in wheat stocks? Well, first of all, it discourages wheat production for this next year. So where do those wheat acres go? And if soybean prices are strong going into the winter, then you would have to think that would favor soybean acres for next year, more expansion, particularly with, and we cannot forget this, we are anticipating, as I said, at least a 20% expansion in area for corn in Argentina, expansion in Brazil, expansion in Ukraine, expansion in Russia. Keep in mind that even before this spring's price rally, because of currency exchange rates, we were dealing with multi-year lows, and because of currency exchange rates, we were dealing with near all-time high prices in many of these countries that compete with us, stimulating increased production. So with that, I've worked my way through the questions. I appreciate you being with me here today. We'll be back again on July 12th with a look at the July USDA crop report, the monthly crop report, and of course anticipate that USDA will plug these numbers into their balance sheet, plus the higher wheat production numbers. Brace for just how high that number may be. Thank you for being with us, and we'll be back with you on July 12th. Thank you.